Welcome to the SPAC Alpha web series. My name is Dan Dombroski, and today I'm speaking with Chris DeMuth. He's a partner and portfolio manager of Rangeley Capital, and whether he's contributing to the Seeking Alpha community or on any type of media platform, he always does a great job of breaking down complicated issues into easily digestible information. So I'm really excited to be able to speak with him today. And with that, Chris, I appreciate you taking the time.
Thanks for having me. It's good to be here. Glad we could have a conversation.
So just right from the top, can you tell me, what are you looking at?
Well, we have a number of different funds that have different particular focuses, but we're value investors. We're always looking for something that's analyzable and something where we can have a view independent from the market on what something's worth and looking for something that's variant. We have a particular interest, and one of our funds is focused on SPACs. That's long been an interest of ours far before the markets kind of discovered them in the last few years.
And you've been talking recently about Renren. Could you walk me through that trade?
Sure, would be happy to. Renren was the next Facebook. The history of things that claim they're the next such and such has an almost perfect record of not being the next Facebook. So it was the once in future, but as it turns out, never next Facebook in China. And they had succeeded at raising capital, but that's about the only thing they succeeded at. They had hundreds of millions of dollars from credulous Western investors at a time when it was easy for Chinese companies to raise a lot of money. They converted basically to a venture capital shop. They just put out a bunch of investments in a bunch of different things. Many were unsuccessful, but their big hit was SoFi, which is kind of famously a recent SPAC target, now trading publicly. I love SPAC bank shot investments, where instead of taking kind of some of the risk of de-SPAC equities, you can kind of take flyers on them. Because my interest in SPACs always was the aspect of taking flyers, being able to do do-overs because of cash and trust. But then once they de-SPAC, what are the public equities where you can get exposure to their success without risk? Renren had this big investment in SoFi. And then a number of years ago, the founder insiders spun it off to friends and family. So it was basically a kind of semi-related party deal where they dividended out proceeds, but at what was at the time generously maybe a quarter of the value, and then over time turned out to be much less than a quarter of that value, right? So they had this one mega hit, and shareholders weren't able to take advantage of it. The legitimate owners were basically defrauded, and shareholders very quickly engaged legally doing a derivative suit, which for people who haven't been in this situation before is a suit on behalf of the company. So you're kind of stepping into the shoes of the company. This can be done especially when the people who would normally be making the decisions are involved on the defense side, right? So you can't necessarily expect, if there's some criminal board member, for them to sue themselves, even if that would be appropriate on behalf of the shareholders. So the shareholders can kind of take matters into their own hands, and they did. And they had a couple big legal procedural successes on the way to today. The defense tried to dismiss the case. That was rejected. That was appealed. That was rejected. And they also tried, the plaintiffs tried to get the securities attached. And so this is the process by which you basically say, this is a Chinese defense. Who knows what can happen to the various securities? Even if we legitimately win, I'm not going to go show up in Wuhan and ask for my money. I might be right, but they have a 10 million man army. So I'm going to kind of, like to defend my rights from a distance. In this case, the judge attached the securities. They basically said, do whatever you want with the securities, but whoever ends up with them becomes basically the defendants, and $500 million was put into trust. This was a decent estimate for what a legal victory would accrue to the plaintiffs. Although there is a theory that if we were just handed the securities that we never should have had to divest ourselves from, that would be actually a bonanza outcome many, many times $500 million. In any event, that gets you to October. In October, we settled for about $300 million. That settlement was, you can kind of say it's somewhere between 0 and 500 million. That would get us 300 million. That would get the defendants released from the other 200 million. They were very happy, and to this day remain very happy with that settlement. Put this behind them reputationally, done deal. The judge in December, because a judge has to approve this, it's kind of like you ask somebody to marry you, they say yes, you're in the court, you're in the church, there's this process for saying, does anybody object? Normally a formality, in this case it wasn't. The judge said, I don't like this settlement. He didn't like that our lawyers were getting a third. I might sympathize with him on that. $100 million is a lot of money. He was kind of offended by that. And he didn't like, he had kind of a personal sense of fairness that was offended by the idea that in a derivative case, the benefits accrue to the current owners, much like if a company put out a dividend, the current owners will get that, and not the people who were harmed at the time several years ago, 2018. Why shouldn't those people get the money? This is nowhere to be found in the law or the precedents or even just the basic definition of derivative class actions, right? It would be as if you and I were on a board and we said, we're going to pay a dividend this year, but there's these other people besides our owners that we find more sympathetic. They have a sadder story. Something horrible happened to them. Shouldn't we give a dividend to somebody else? It kind of violates the definition of the terms. There's no legal status for that. It doesn't exist. It's just something in his imagination that was fairer. The share's worth something like $5 a share without the settlement, and the settlement, depending on how much the lawyer's fees are cut back, worth something like $28 per share. So it would just go to a different group of investors, and it would basically turn this derivative case into a damages case, into a class action case for a class that has not ever been certified, that doesn't exist, that actually couldn't exist under Cayman law, where this, which is the relevant law for this case, even though it's a New York court. So it's kind of inventing a history out of whole cloth. It's inventing a class out of whole cloth. It's inventing a whole section of law that there's no statute for in Cayman's, no precedent for in New York. There is no standing for the objection. It's just in one man's imagination, there's a totally different way to do things, and that would be nicer.
And so how does he feel as though it's fair?
Well, I think he feels it's fair because the people who had something bad to them done will get something good, and that presumably greedy hedge fund managers who jumped into the situation to exploit somebody else's tragedy shouldn't get anything. I think that's kind of the best you can do. The order read like a C paper at a L1 wrote at a state law school. It was not something that really looked like a legal document. And it goes next before the appellate court in March or April. And these are appointed, not elected judges. And quite possibly the judges who were the ones that had actually rejected the dismissal early on and who had implicitly accepted our current group as being the relevant one in this derivative case. So maybe the same ones, but certainly ones in the same position. And so I have, high expectations that they will be serious people and look at the law and look at the precedent. And there's really, a lot of my mental gymnastics and thinking about investing is really trying to kind of kill my ideas and try to say, like, what's the right way to think about this where I could be wrong, I'm 100% sure that the correct decision on appeals is for the order to be overturned and the settlement to be put back. And then you just discount that for whatever percentage you think is reasonable for people making a political decision or agreeing that it would be somehow vaguely progressive. I mean, these are all just investors who gets money. I mean, there's not like a little guy issue here, but vaguely the idea that money should go to people who are harmed, not people who subsequently bought securities. But it's just made up. It's just somebody's feelings. Somebody's imagined a different system, which maybe we should have a better system. That would probably be a better role for lawmakers to create a new category of law prospectively than just for a judge to imagine it retrospectively.
And outside of the Renren play, what else are you looking at within the SPAC space?
In the SPAC space, so things have really changed quite a lot this past year. I mean, it feels like there have been like 3 or 4 different eras of SPACs. So I am not much of a stock market guy. I think I'm much more of a try to understand teams, try to understand who would do really good deals. I love corporate deals and deals that have strategic pipe interest. So like one of our biggest positions is in the Liberty SPAC. It's a team that we've been invested, kind of our biggest, oldest investments have typically been in the Liberty complex. I quite like that management team and knew that I wanted to have a big position in their SPAC when that launched. So we typically start at the beginning, you know, our kind of conversations begin in testing the waters. We typically invest in the IPO. We're not that active in the stock market. And then we come back in later if there are opportunities in the pipe or the FPA or other ways for us to get involved. So Liberty is an example of the kind of thing we like in a pre-deal SPAC, but we're usually involved very early. And then based on market supply and demand, we really just try to be thoughtful. We try to kind of, I think about my team and my role as like the most SPAC sponsor friendly outside minority passive investment. And the way that we kind of came to this kind of SPAC friendly role was that because we don't have an enormous amount of public stock market trading activity, we're not huge Wall Street customers. We don't have, you know, hundreds of millions of dollars of fees that I'm paying each year. And so we're not the very favorite hedge fund in the history of underwriters, right? The convenient way to get good allocations when something's kind of hot is to pay hundreds of millions of dollars of fees. And then when you ask something from that Wall Street firm, they'll kind of give it to you. They'll kick some, you know, value back for what you've paid them. We're never going to be in that situation. And instead, we try to be in the situation of saying, okay, what does this team need? Where can we really make a difference? We typically like to invest in risk capital. So, you know, my ideal relationship with a SPAC sponsor is one where I can either through an anchor investment or simply buying from sponsors risk capital. And that kind of keeps my attention. And then once I have risk capital, then I kind of will say like, okay, well, we're going to make this thing work. And if that means we are coming back with a pipe, we are finding other people interested in the pipe, we're kind of coming back and really kind of staying as kind of literally, figuratively kind of invested in the success of these things. And then just kind of, you know, we have preferences. We like bigger SPACs more than small SPACs. We like experienced teams. We really like to kind of poll peers and see kind of what kind of market reception they're getting. And then especially this year, I would say I like nimble, flexible teams that are well poised to pivot thematically when the market really shifts.
You talk about risk capital, and I hear that term thrown around a lot, but it feels like it's rarely dived into. Could you elaborate on, you know, what your perception is, or how you define that, how you look at that risk capital?
Sure. So just a typical SPAC has to kick in some money themselves. A huge one will be, $20-30 million. It's more typically for an average one, kind of high 7 figures, low 8 figures that the SPAC sponsors put in, that where they're buying the securities that then they'll have to get exposure to their SPAC, but that also is kind of the money that the SPAC needs during the process, and then the rest of the money is raised in a trust in the IPO. One of the ways that I've kind of more recently been interested in getting involved in these is that the past year, an average SPAC could raise a trust at par, $10 per unit IPO. That's ticked up, call it about a couple percent. Typically now more like kind of $10.20. The sponsors who decided to have a SPAC didn't necessarily predict that, especially as the market shifts, as the amount of cash and trust has to go up. So one of the things I've been doing is coming in and saying, hey, I'll fund part of or all of that extra money that needs to go into trust. That just the fact that they didn't plan to need it. And so that's kind of will be the amount that I'll typically kind of start a SPAC investment with.
You were also talking about being nimble as a sponsor, and you've previously spoken about your fondness for DMY. What is it about them that sticks out to you?
Yeah, I like and trust the sponsor. Somebody who's done a lot of deals, both in Niccolo de Massi's corporate career and his career as a SPAC sponsor. They have a lot of technical expertise that I lack. And simply as a repeat sponsor, we've done this several times in the past, and some of these have been quite successful. So, kind of as I look to have a diversified exposure to SPACs, it's one that I like and trust, and has had a good relationship. He has a good relationship with the advisors. He has a good relationship with investors, and he's able to raise a lot of capital in pipes. One thing that's really changed is that early last year, there was a lot of kind of hedge fund interest in pipes that's largely gone away. And so what that needs to be replaced with is sponsors that either have very deep pockets or very good relationships such that they can raise a lot more strategic pipe money. So, the kind of strategics that want exposure to a company for different reasons than just kind of arm's length financial intermediaries, that's going to just become critical. And there's going to be a huge number of liquidations, and those liquidations are going to heavily be the firms that don't have the scale and the relationships. You want somebody who, if you're $100 million SPAC, but you're affiliated with a $10 billion VC firm or private equity firm or hedge fund, that's willing to come and back that SPAC to the hilt, ideally even named after the same thing, if there's some kind of ego and reputational and senior management exposure to it, that helps a lot. And even better if you're a $10 billion closed fund. So if you're a fund that says, hey, I had $20 billion of demand, I had $10 or $15 billion of assets under management, we can just fund this whole thing. But even if we didn't, we could raise a finger, and there's a lot of people who want exposure to our ideas that haven't been able to get it because we're closed. I mean, that's kind of the ideal SPAC sponsor. And then the inverse is some dude with a couple $1 million, you might think you're getting feedback from the underwriter, but underwriting SPACs is just a fabulous business. I mean, it's sort of akin to the ratings agencies in 2007, 2008. If anybody's looking for them to hit the brakes, I mean, there's just no reason for them to, right? There's 500 companies in the S&P 500, give or take, but there's 500 new SPACs you could start every year, right? Like it's just kind of, you're creating customers and getting paid fees for it. So maybe some guy who's kind of, a third tier sponsor with a third tier advisor starts something like those are all going to liquidate. I mean, there are going to be a lot of liquidations. And so I'm looking for the ones that are deep pocketed, great relationships, especially on the strategic side. And then when it comes to being nimble and flexible, what I'm really looking for is there's been a massacre of never profitable speculative tech companies over this past year. If you look at ARC, which is kind of a favorite short of mine, they've really run into some trouble. That's not what you want to build your SPAC around right now. But I think there's a lot of kind of thematic opportunities in the market. And I think the fact that the market, there's this rotation going on right now into very different sectors. There's a lot of just amazing opportunities, and SPACs, might have missed a beat or two towards the end of this past year, but they're actually going to be more flexible at kind of going after what this market is most interested in than traditional IPOs or other types of ways to come to the market. And one way, just for example, is if you look at the combination of kind of speculative ESG companies and speculative ESG market interest, there's this huge hole that's left over for kind of non-ESG or antithetical to ESG energy needs, where we have a kind of theory of where we'd like to be decades from now. We have a reality of where we are today, and they don't come close to connecting. I mean, they're two different subjects, and it's almost kind of a religious adherence to a new world where we're just not in it, and we do not have a way to get there without much more reliance on petrochemicals. And to the extent that there are people who don't want to invest in them, to the extent that there are companies that want to start kind of on the religious theory side of ESG, there's going to be a ton of money to be made for people who are willing to make sure that countries don't freeze in the middle of winter, that don't have enough energy, or have energy at prices that are just skyrocketing on oil and gas in Europe, and could come to the US with very, very precarious energy infrastructure with commodity prices that could explode.
Now, you were just talking about the environment for the pipe market a few months ago. What does that currently look like?
It's changed dramatically. The financial only interest has dried up completely. A lot of it, and it's a little hard to judge sometimes, has to come from the sponsors themselves. So you should really start a pipe marketing where you're really willing to offer a lot of concessions or participate in a lot of it yourself, right? Sometimes you see headlines like, oh, they were able to raise a $150 million pipe, but it turns out like 125 of that was the sponsors themselves or an affiliate or semi-affiliate. And I tend to be kind of a semi-affiliate, or in the sense that I'm kind of pot committed and not going to be there for all of it, but would be there for a lot of it if necessary. So that market's really changed, and more convert deals. I kind of like convert deals, so that's fine with me. Fewer equity only, fewer kind of common stock based pipe deals, and harder to get hedge fund interest.
No, I mean, part of the appeal of the structure is that convexity through the warrant, but as the structures are changing, and let's say you get a stock only, what's the appeal to the upside for putting these transactions on?
In theory, it's because you love the transaction. In practice, it's because, and this isn't always very clear what precisely it is, but in practice, it's usually you're getting something else out of it. So a typical offer would be downside protection down to a given price. So it's like the attraction is, give me $10 to invest in this deal, and you're buying it at $10, but I'll make you whole down to $6. So that would be a very typical offer if I was a SPAC sponsor trying to get a pipe done, and you were, and I was trying to market it to you. I could just say, hey, let's just do the pipe nominally at $8, but that's kind of not as attractive, and that'll piss other people off. But so having protections, so either kick in a warrant and have upside exposure, or kick in protection down to a certain level so that you can't lose down to, 7 or 6 would be typical.
Now, another point that you brought up, looking at this from the regulatory perspective, how do you foresee that changing over 2022?
Good question. We'll know a lot more in March and April. This is a very aggressive administration on the regulatory front. You know, if you look at the, you know, across bodies, not just SEC, but if you look at the FTC and others, there's a lot of kind of regulatory activism. I certainly have a hope here, and it relates to SPACs, that might be the mildest of expectations, that it's going to be very disclosure focused. I think that's appropriate. I think that's a real government function. I think that's fine with me. I mean, these guys nominally are supposed to protect us, right? Like, they're supposed to be advocates for investors. We're investors. So if it is more disclosure and clearer disclosure, maybe more standardized disclosure that makes it easier for average investors to see things that are true about SPACs, that's fine with me, probably good. If it is trying to reconcile with IPOs, things about what you can market, that's probably fine. I prefer to make it all looser than it all tighter, but the idea that they should be in line, that's fine. And the idea that they should go after bad actors, that sounds great to me. So if it's a matter of going after people who committed fraud, that's fine. And probably my biggest hope would be that it is maintaining alignment. I mean, my whole interest in this is the hope that as an investor that I'm aligned with insiders. And I said, you know, I like investing in at-risk capital, but I especially like being the only one who's an outsider in risk capital. I don't love it when they just want to syndicate all of their own equity, and then I'm just they're just managers, and I have the risk that they once did. That's discomforting. So the idea that, I mean, somebody on Twitter wrote as a joke, my favorite regulatory reform, which is you can project out as far as you want. You just can't take any equity out until the last day of your projection on your marketing doc. So you can tell the people what your EBITDA will be in 2030. You just can't take any of your own money out until 2031. And that was said tongue in cheek, but I actually think it's a great idea. Having some more alignment between what people think is knowable and where they have their own exposure. The idea that they're, you know, there's been some pretty unseemly SPAC de-SPACings where there's kind of extremely aggressive, not just optimistic, but kind of with a precision that I would describe as impossible, projections used to raise a pipe. And then very quickly thereafter, once it's all raised in public, they get to their first quarter and they'll bring in new management and they'll say, well, we have to be realistic now because we're a public company. We have to kind of more or less tell the truth and bring things way back down into kind of a more sober view of the world. That's, you know, and we're not talking about anything that happened to the business in the interim, just using hyper optimism and precision to market and then bringing it back down, sometimes bringing new people so they're kind of cleansed to manage it. That's something the SEC is going to and should have a really close look at, but that's all for the good.
What do you think of activity going forward?
Well, it was frenetic this past year, but that was largely because it was so frenetic in January and February. So 2020 was the busiest year for SPACs ever, and then 2021 was busier than 2020. So it could cool down quite a lot from that and still be a very healthy, busy market and plenty of things for me to look at, even if it was kind of cut in half this year or something like that. I think it's going to be somewhat muted until the SEC has more clarity. It really hit things hard when they wanted to change warrant accounting treatment. Even though that was largely benign, it was just kind of unsettled the market for a few months. We could easily have that for the next few months. But even thereafter, I think you're going to have a SPAC market that I would describe as meritocratic. That you know, it's at its most heated months. You had a lot that I didn't think should have ever been launched, and I think as you have some substantial liquidation percentage, you know, it retrospectively has been like 3%. I think it'll be 10 times that at least. So once, you know, you have 30% of these liquidating, something like that, maybe more, I think that will make things more meritocratic. But then when I talk to people who are kind of the best SPAC sponsors with the strongest pedigree and deal experience and operating experience, people who really know the industry they're focused on, they're not that worried. And I don't think they should be.
Well, I certainly appreciate you taking the time to speak with me today.
Thank you very much. This has been a good conversation. I really appreciate it.